Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastep Jr.
Hello and welcome back to the Ask Ralph Show. My name is Ralph Eastep Jr. I have an accounting practice in Middletown, Delaware called TCJA Accounting Plus. I want to welcome you to the show. We do this show every week to share information. We also offer a podcast. That podcast is called Ask Ralph. You can go find those podcasts at the iTunes store or anywhere else you get podcasts. And we've got a huge library of information that you might benefit from. Well, with it being tax season right now, I thought I'd talk a little bit about what could potentially cause you to get audited. And that's a dreaded thing. That's probably one of the main things when people come in to see me. I come in to see you, Ralph, because I don't want to get audited. So let's take a little bit of time here and talk about some of the things that we would call red flags for audit. Now, the number one biggest red flag, to be absolutely truthful with you, is having high income. That's the biggest one. And we'll talk about that. But there are other factors at play that can spur attention from the IRS, especially now with this new 2018 tax code, or what they call the Tax Code and Job Acts. And don't be dismayed or don't be into a false sense of hope that, because the IRS is just getting back on its feet after the partial government shutdown. They are still going to be looking at tax returns to look at auditing. And the thing you need to understand is much of this is done through automation. They look at certain discrepancies and, they have scores for all this kind of thing, So there is some risk for this. And the truth is matter, but at the same time, don't go crazy about it because most people will never face an audit. Statistic here that's cited, it's in the IRS data here. It says of the nearly 148 million individual tax returns filed in 2016, just under 1 million, or about 0.7%, were audited. Now, remember, audited is something different than, you got a letter from the IRS, such as a notice on an income reporting discrepancy and a proposed additional tax due. We're not talking about those. Those happen more frequently because the IRS does match things up. But think about it. 0.7% were audited. Now, here's another statistic that's interesting. The one item that puts you at most risk for an audit is making a lot of money. So what is a lot of money? If you earn more than $1 million, the audit rate jumps to 5.8%. So we talked about 0.7 in general, but if you make over $1 million, now you're at 5.8%. So I guess the answer is don't make over $1 million. No, just kidding. But it's not just income that's the only consideration. I mean, that definitely is a big one because the IRS got wise a few years ago and realized, look, why are we going to audit people that don't have much income? What could they possibly have that we're going to collect from? And it was a strategic decision that absolutely made sense because now they're going after people with means. They're going after people that have money. Because the truth of the matter is, as much as we don't want to admit it, those are the people that are going to have the opportunity to be involved in things that could be a little shady or things that might be a little questionable in a tax return. And they have the biggest reason to because they pay the highest taxes. So what are some things besides income? And one of the things that I always bring up in my practice is large charitable contributions. Now, that being said, I'll have a client say to me, well, Ralph, listen, I give money, I give clothes, I give all those things to Goodwill, Salvation Army. So, what's the amount that I can give that won't throw up a red flag? And I can never give them an answer to that. Now, with the new Tax Reform Act, I think this is even a bigger issue. Because a lot of the things that we could deduct before on the itemized deduction schedule have gone away. You've still got mortgage interest, property taxes to a limited extent, but you've got that charitable contribution area there where people, are still able to use that. So one of the things that a lot of people have been recommending, like myself, is what's called bunching charitable contributions. And that basically what you do there is you give 2 years worth of charitable contributions in 1 year. So for example, let's say you give all your church donations this year. Next year, you don't give any. So in this year, you itemize. Next year, you'll take the standard deduction, because you figure now it's $24,000 for married filing joint. But here's where this becomes a problem. The IRS has a set of statistics that show, based on your income, here's how much they expect for you to give in charitable contributions. Well, if you're doing this bunching strategy, then you're going to be effectively doubling up on that. Now, that's not to say that you can't do this strategy. I think it's a very wise strategy. But just recognize the fact that you may get audited. And don't fear that either. If you get audited, You just need to make sure you have documentation to back up your donations. There's nothing to fear here. If you're being honest and you've got your documentation, then an audit is nothing more than a checkup. And remember now, with the contribution limits, you can give up to 60% of your adjusted gross income to qualified charities. But I will guarantee this. If you're a person that doesn't usually give, and then all of a sudden you file a tax return where you're giving 50 or 60% of your income, I would be willing to bet that you are going to get audited. So just something to keep in mind. Now, another non-income based area is rental activity. This is an area where people get audited. I mean, it's just true. If you rent out space, whether in a whole house or a room for more than 14 days of the year, you must report the income to the IRS. Now, how many people rent out a room or, I got, my friend Joe staying over here and he throws me a couple $100 a month, something like that. Well, the truth is, if you're renting it out more than 14 days a year, you've got to report that income to the IRS. Now, with reporting that income, you also get the benefit of taking some expenses, such as local licensing, fees you pay to online platforms, advertising and marketing, and all the associated business costs that could be deductible. It may even be, you may be able to deduct some home expenses, for repairs, mortgage interest, property taxes, utility. Now, of course, they are prorated based on the number of days you rented out the house or the amount of space you rented out the house and the number of days. So if you just rent a room, the same expenses are deductible, but to a lesser degree. So for example, if that room takes up 25% in your home, you could deduct 25% of the expenses allocated to the days it was rented out. But just remember, this is not, you have to report. This is very important. If you decide to rent a room, make sure you have the documentation. And I think the biggest area for red flag is unreported income. This is one of the consistent areas that cause the IRS to question your return is the discrepancy between your reported income and the information the agency has. Think about this, folks. When you work for someone, they are going to send that wage statement or W-2 to the IRS. Or it could be a 1099. Let's say you were a subcontractor. They're going to send that to the IRS. If you get a 1099 from any pension distributions or, bank account interest, if it's more than $10, they're going to send that to the IRS. If you don't report those, you are going to hear from the IRS. It's pretty simple. Now, those are the obvious ones, but if you work on, what a lot of people say, like the word is side hustle, make sure you're keeping track of that. Make sure you're keeping track of your income and expenses. Because if you do get audited, you're going to need to substantiate that. And that goes along with cryptocurrency. I mean, that's kind of a big deal now, but the IRS has put in place ways to make sure people are reporting their gains and losses on cryptocurrency. And then the final thing is overseas accounts. And, you need to consult with a tax advisor, accountant, if you have any kind of overseas accounts, because there is a ton of regulations related to that. And you can get yourself in a world of trouble, for willfully not reporting those things. So I hope this was helpful as we talk about IRS red flags. Join us next time or go to the Ask Ralph website and check us out and see if we can help you.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.